Something big is happening behind the scenes. Ethereum's rally isn't just about ETFs or upgrades, it's about companies hoarding Ethereum at a scale that could rewrite the market. Remember when one company turned its balance sheet into a Bitcoin vault and its stock went vertical? Now imagine that same treasury model applied to Ethereum, a network that pays yield, moves trillions in stablecoins, and anchors DeFi. In this video, we'll unpack the 5 largest Ethereum treasuries, how much Ethereum they've already locked away, and why this arms race could change everything for Ethereum's price. Before we dive in, most people watching right now aren't subscribed. If you're enjoying the content, hit that subscribe button. It's free, it helps the channel grow, and you can always change your mind later. Back in 2020, Michael Saylor shocked Wall Street. He took a sleepy business intelligence firm and turned it into a Bitcoin black hole. The play was simple, but brilliant. Cash was melting, so he swapped it for an asset that couldn't be inflated away. The result? Strategy stacked an almost unthinkable pile of Bitcoin, and its stock went vertical. That blueprint didn't stay secret for long. Dozens of companies have since copied it with Bitcoin, but markets evolve, and so do incentives. A new wave of firms is now running the same playbook with Ethereum, and this twist changes everything. Because Ethereum isn't just digital gold, it can be staked, restaked, and woven directly into the plumbing of stablecoins and DeFi. A balance sheet full of Ethereum doesn't just sit there, it can actually grow itself in native units over time. The mechanics look familiar. Raise cash through equity, debt, or placements, then go shopping. But instead of parking the asset in cold storage, these companies plug it into yield pathways that Bitcoin simply doesn't have. If Ethereum outperforms and the stack compounds on top, the effect isn't linear, it's exponential. If you want exposure to Ethereum, why not just buy Ethereum directly? Fair question. The answer lies in something called MNAV, the multiple on net asset value. Sounds fancy, but it's simple. Take the raw value of the Ethereum a company holds, then compare it to the company's market cap. If a firm owns $10 billion worth of Ethereum, but the market values the stock at $14 billion, that's a 1.4 times MNAV. In plain English, the stock is worth more than the coins alone. Investors are paying a premium for the structure, the access, the yield strategies, and the flywheel of growth. We've seen this movie before. Strategy's market cap has consistently traded above the value of its Bitcoin stack, creating a reflexive loop. Higher premium, more capacity to raise, more buy-in, stronger premium. With Ethereum treasuries, the same loop is in play, only stronger, because Ethereum doesn't just sit there. It earns yield, it powers stablecoins, it drives DeFi. That extra layer of performance can push MNAV even higher, sucking in more capital and fueling the cycle. That's the theory. Now let's meet the players racing to prove it in the real world. Bitmine started out as a plain old Bitcoin miner, but in mid-2025, it made a pivot that shook the market. The company raised fresh capital, announced it was becoming an Ethereum treasury, and kept mining operations running on the side. The market didn't shrug, it went ballistic. Bitmine's stock went vertical as the company began buying Ethereum in rapid succession. At the helm is Tom Lee, a Wall Street veteran who now chairs Bitmine. His thesis is bold but clear. Stablecoins are crypto's killer app, and since most of that activity runs on Ethereum, Ethereum will be the biggest winner. But Lee didn't stop there. He openly admitted what others only whisper. If a company consolidates a massive on-chain position, it creates its own gravity. When you hold enough of the network, you're no longer just an investor, you're a systemic player. Wall Street has to pay attention. Nation-states might too. And Bitmine's actions have backed up the talk. In a series of rapid-fire purchases, the company amassed about 1.2 million Ethereum, more than $5 billion worth, nearly 1% of the entire supply. That's already enough to make the market rethink what being corporate demand for ETH looks like. And they're nowhere near finished. Management has floated targets in the tens of billions, framing this less as a strategy and more as an arms race. The model is classic treasury with an Ethereum twist. Reinvest cash flow, raise against a premium stock price, stake the Ethereum to grow the base, and use volatility to buy more on dips. So far, the market is rewarding the aggression, and Bitmine has planted its flag as the frontrunner in the Ethereum treasury race. Sharplink's story goes back long before crypto. Born in the 90s as a sports betting and casino marketing company, it shocked the market in March 2025 with a single announcement: raise hundreds of millions and pivot into an Ethereum treasury strategy. And this wasn't just any pivot. The board chair is Joseph Lubin, one of Ethereum's original co-founders and the founder of Consensus, the company behind MetaMask. When someone with that resume says Ethereum treasuries are critical to the network's future and then puts real money behind it, people take notice. The reaction was instant and violent. The stock ripped higher on the news, only to collapse months later when Sharplink expanded plans to sell up to $1 billion in equity. But reflexive loops cut both ways, as the company followed through, buying hundreds of millions in Ethereum, staking its position, and keeping the accumulation steady. The stock found its footing and began climbing again. Sharplink has also shown it's not afraid to be opportunistic. Case in point, a discounted 10,000 Ethereum purchase directly from the Ethereum Foundation. That's more than just good optics. It proves the company has deep connections and access to deals that can accelerate its treasury. As of this recording, Sharplink holds just under 600,000 Ethereum. And with plans to raise, expand, and keep racing the competition, the message is clear. They intend to be a permanent, visible pillar of corporate Ethereum demand. The Ether machine is the newcomer with a familiar lineage. It's the product of a merger between the Ether Reserve and Dynamics Corporation, targeting a public listing under the ticker ETHM. The founders have long histories inside Ethereum's core ecosystem, which matters when your strategy leans on staking, restaking, and DeFi integrations that require real operational competence. Despite being new, the opening salvo was anything but tentative. The Ether machine started with a blockbuster purchase, nearly 320,000 Ethereum, followed by additional bytes, as it marked Ethereum's 10th birthday and took advantage of subsequent windows. At the time of recording, they've crossed 345,000 Ethereum with significant cash still on the sidelines from an initial multi-billion-dollar capital plan. That war chest is the point. When you raise more than you deploy, you're telling the market you'll be back, and the market tends to front-run that. The go-forward plan leans hard into native Ethereum economics, stake base holdings, explore restaking and curated DeFi to add incremental yield and keep dry powder for drawdowns. If they execute, they'll accrue not just Ethereum, but credibility. The intangible premium MNAV needs to stay elevated. Digital's path to Ethereum wasn't linear. It started as a China-based rental company, pivoted into Bitcoin mining, experimented with Ethereum mining before the merge, and then, seeing where the puck was going, shifted again toward high-performance computing and staking. The decisive break came this year when it exited Bitcoin mining to become a pure-play Ethereum treasury and staking company. Markets initially hated the dilution risk, but the company moved quickly from promise to position, buying 100,000 Ethereum in a single shot, then adding more to pass 120,000 ETH. The stated ambition is blunt. Start with 6 figures, then climb aggressively with the goal of being the preeminent Ethereum holding company. Execution will decide whether investors reward that vision with a real premium. Digital's edge is operational. It already understands infrastructure, has a roadmap that includes spinning out HPC assets, and can channel proceeds toward Ethereum accumulation. If it keeps translating headlines into on-chain balances, markets will likely forgive early jitters. ETHZilla has the best name in the group and one of the stranger origin stories. It began life as a biotech company, rebranded after locking up hundreds of millions in private funding with a who's who of crypto backers, and laid out a plan to build an Ethereum treasury supported by an external asset manager with deep DeFi chops. The initial market reaction was messy. Stocks don't always reprice cleanly when business models change overnight, but conviction attracts capital, and conviction from the right sources can ignite reflexivity. When a prominent tech billionaire disclosed a sizable stake, the stock went vertical, and the company followed with its first major Ethereum purchase, more than 80,000 coins in a single day. What makes ETHZilla interesting isn't just the speed of the pivot, it's the mandate. Accumulate Ethereum, put it to work across staking and liquidity, and use a DeFi council to keep the strategy on the rails. If they execute, they'll demonstrate another path for corporate treasuries. Professionalize DeFi at public company scale. Let's zoom out and ask the only question that really matters for price. How much Ethereum is getting taken off the market and how much buying power is still queued up? Currently, the top 5 treasuries hold about 2.3 million Ethereum, just under 2% of total supply. Across all identified Ethereum treasury companies, the number jumps above 3.5 million Ethereum, roughly 3% of supply. At today's prices, that's tens of billions of dollars already absorbed. But the more important number is the dry powder. The 5 biggest players have raised or signaled plans to raise north of $30 billion, with around 9 already spent and nearly 24 billion still to deploy. Translate that into coins at current prices, and you're talking about something on the order of 5 million additional Ethereum that could be purchased over time. Add that to the existing 3.5 million, and you're approaching 8 to 9 million Ethereum controlled by corporate treasuries, something like 7% of total supply. Are these back-of-the-envelope numbers? Of course. Capital raises change with markets. Some firms will over-deliver, others will stall. But you don't need perfect precision to see the shape of the impact. When structurally motivated buyers with flexible balance sheets decide to accumulate a yield-bearing asset that already has a large portion locked in staking, supply becomes a narrative, and price becomes a function of how fast the buying hits. Reflexive loops are a double-edged sword. On the way up, a premium can supercharge everything, but when it flips the other way, it gets ugly fast. If a company's MNAV turns negative, if the market cap drops below the value of its Ethereum stack, raising money dries up, investors get restless, and management is forced to rethink strategy at the worst possible moment. In the extreme, heavily levered firms could even be pushed to liquidate, creating selling pressure in the very asset they're supposed to be accumulating. That's the trap. The good news for Ethereum treasuries is that Ethereum has something Bitcoin doesn't: native yield. Even in choppy markets, staking rewards continue to pile up in Ethereum terms, helping rebuild the premium over time. And as long as the bigger trend points upward, with Ethereum cementing its role in stablecoins, settlement, and DeFi, investors have a reason to keep assigning that premium. The risk is real, but it's not fatal. Yield, staking, and a growing set of conservative on-chain strategies give Ethereum treasuries a built-in resilience the first wave of Bitcoin treasuries could only dream of. Every crypto cycle has a catalyst nobody saw coming a year before. In 2020 and 2021, it was institutions piling into Bitcoin the only way they knew how, through public companies that raised cash, bought Bitcoin, then raised even more. This time, the proxy is evolving. Investors don't just want digital gold. They want Ethereum's monetary premium, plus the cash flow-like yield it can generate on-chain. Ethereum treasury companies are packaging both in a single ticker, and Wall Street is lining up. If this arms race keeps accelerating, the question won't be whether Ethereum can reclaim old highs. It'll be how fast corporate buyers can vacuum up the available supply. And that process isn't linear. Buying creates premiums. Premiums enable new raises, raises fund even more buying. Layer that on top of a network where staking already locks away a huge share of coins, and it doesn't take wild assumptions to see how Ethereum could run far higher than most people are prepared for. So where does that leave us? With a simple, uncomfortable truth. Ethereum's price no longer lives and dies on headlines or upgrade dates. It's being driven by structural demand. Public companies that have decided their mission is to become long-term Ethereum sinks. The numbers are big, the war chests are real, and the playbook already works. If these teams execute, today's treasury totals will look quaint a year from now. If they stumble, we'll get a masterclass in reflexivity on the way down. Either way, the story has changed. Ethereum isn't just an investment anymore. For a growing list of companies, it's the balance sheet. If you've made it this far, you're serious about crypto. Do yourself one favor. Hit the first link in the description and subscribe to Crypto Nutshell, our free daily email. We write it every morning. It takes 5 minutes max to read. We cover the biggest stories, the sharpest predictions, and the on-chain data that actually matters, delivered before the market opens. It's fast, it's free, and it keeps you ahead of the curve. Thanks for watching. I'll see you in the next one.